Welcome back everyone to the Moneycontrol Livestream. You are watching Markets with Santo and CJ. Well, markets were looking pretty strong throughout the day except for towards the end when it seems like we have given up all of our hope to close the session in the green, and while Nifty has slipped into the red momentarily, Sensex is still holding fort in the green territory, and it seems that investors are unable to decide amidst the conflicting developments that are coming out from global markets as well as our own. While on one hand you have the excise duty cut which has eased inflation fears at home, on the other hand you have rising COVID cases in China, which is leading to fears that there could be another lockdown in the offing in Beijing, which is another industrial town, let's not forget. Apart from that, you had US President Biden coming out with a very stiff warning to his Chinese counterparts to not get involved with Taiwan or there will be consequences. Apart from that, of course, the big story of the day is what is happening to metal stocks, Santo. It's bloodbath. They have been butchered. I mean, जज्बात बदल गए हैं, कहानी बदल गई है, पूरा story बदल गया है for metal stocks today. The Nifty metal index is down as much as 8% at this point in time.
Well, CJ, there's no mistaking it now. Central banks are very clear in their intent. They've made it amply clear that till they bring inflation down, they're not going to relent. If you notice the tone of Governor Shaktikanta Da's interview to CNBC TV 18. Lata Venkatesh earlier today, it made it very clear that a rate hike is kind of a no-brainer. So just be prepared for higher rates, and that being the case, at higher levels, clearly you're not seeing enough buying support come in. That's what you saw this morning, markets rallying, but then after the positions were squared, there's just no follow-up buying at higher levels. So this is a market which I think CJ could keep gradually sliding lower and lower.
Well, I think market will at least be happy with the fact that RBI at least has come out finally and become a little bit more clearer with the communication, given what has happened over the past 2 months from the February meeting where it was ultra dovish, ultra accommodative, to the April meeting where it was dovish and accommodative, and to the emergency rate hike that just caught everybody on the wrong foot. So thankfully, at least now market is prepared. I think, Santo, from that point of view, although market has already started preparing itself for eventual rate hikes, and the government measure recently will probably maybe tone down the extent of the rate hikes, but we know that rate hikes are going to be there, and that remains the main point of takeaway from that RBI interview.
Yes, it's the perfect storm at this point. Rates are going up, commodity prices are quite high. There's still no clarity on whether inflation will be coming down shortly, and then you have the hit to earnings in this quarter. So all put together, there's very little going for equities at this point in time.
Yeah, I mean, at least from a point of view of triggers for bulls are very few, but at the other end of the spectrum, even bears are finding it hard to really have a very long run or long stretch of gains or winnings at this point of time. If you look at it, we have still not broken below the March low despite the volatility, despite the mayhem, despite the negative macro news. We are still holding fort. So that gives me quite a bit of confidence that probably we will consolidate at these levels, and maybe just maybe when these concerns are eased, have gone to the background, maybe we could see a major spring-like sort of a move in the latter half of the year.
CJ, that's what the thing about bear markets, that they're very treacherous. So they don't fall in a straight line. You would normally expect that once a bear market sets in, prices just slide down one way. It doesn't happen. As you've been seeing since almost October now, they fall, rise for some time. It then attracts a lot of people thinking, well, the correction is over. Then it falls some more, and you find reasons along the way, some or the other reasons coming up all the time. So in March, when it fell below 15,000, below 16,000, and then rebounded very sharply, you thought that things are now beginning to look up, but every time it seems to be making a newer low.
That's a Santo. Let's quickly dive into some of the stock action, of which there were a lot. So it was very difficult for us to tone down into 5 stocks. But starting off with
Jindal Steel and Power, this has been among the biggest losers today, obviously because of the government moves to increase export duty on steel and also iron ore pellets. Now, Jindal Steel and Power is one of the major players in the iron ore pellets as well, and it's bound to get hit, and that's where the sharpest hike in duty has come through, from nil to about 45%. That's like a very, very huge one.
Steep,
and so you're seeing the stock getting hammered down. Now, I think I would say, CJ, that the spirit uh, for metal stocks in general has been broken, and you're unlikely to see them now come anywhere near the highs that you saw them quoting at till about a year back. Jindal Steel and Power also had a fairly good run. I think this is a stock I would now be bearish on.
It is a policy shock, Santo, for the steel sector. There is no doubt about it. But I will still be a little hopeful that there is a possibility that this could be a more short-term sort of a measure in order to douse the fire of inflation at this point of time, then a very longer-term structural shift in the government's policy making, because this government has been over the past 4 or 5 years very supportive of boosting export. As latest as March, you had the steel minister coming on Twitter and actually celebrating the fact that steel exports had jumped so high over the past 2 to 3 years. So I still hope that this is a very short-term measure, and if that is so, then we could see actually a short-term bounce back as well on the counter. Apart from that, if you look at it, from a very earnings point of view, government may not want to push the steel sector into an earnings recession, because let's not forget what had happened last time the steel sector was in an earnings recession. We had NPAs mounting for the public and the private sector banks. So I don't think government would want to make it that bad a situation for the steel space. That said, one space where things are actually looking up after what has been a very sordid year is the IT space. And within IT space, Persistent Systems were doing quite well today. The stock was among the outperformers within the mid-cap IT space. And overall, if you look at the structural story for mid-cap IT and Persistent in particular, the demand story remains strong, as I have mentioned in the past. And apart from, the demand side, the margin, concern that was there, that also seems to be, easing a little bit, largely because of the fact that IT sector is going to get a lot of support from the depreciation in the rupee. So that might be able to cushion some of the blow on the margins because of the wage hike. Apart from that, if you look at it from a valuation perspective, I mean, this is a long-term story which has already fallen, 24% from its record high. And therefore, risk rewards had turned very, very attractive from a, 12 to 24 month point of view if you want to take that trade again. If you have missed out on the IT story probably in the past 1.5 years, maybe now is the time to get back into it slowly and steadily.
CJ, hard to pick holes in that argument, but just remember, when the market sentiment changes, you just can't compare stocks, view it against the peaks that they touched some time back. So,
right,
because the stock is down 30 or 25% from the peak doesn't automatically make it a great bet. Persistent is a good stock, no doubt. It's managed to hold on to its margins in the fourth quarter, which is where probably it stood apart from the rest of its peers. Exactly. But there's just one thing that worries me a little about Persistent is that still it's among the expensive stocks in this space. It's about right now it's quoting at about 44 times trailing earnings. Considering the fact that some of the bigger names are quoting at far less valuations, this is something that has me slightly worried about.
That Persistent. Is also because it has a lower base and therefore is growing faster than many of his bigger peers, right, Santo? So therefore, the valuation premium will always naturally be skewed towards the mid-cap stocks. That said, I think you have one big shot blue chip that you really want to go
Larsen
for.
and Toubro has been one of the steady performers in this volatile market. The fourth quarter numbers were pretty decent, and generally the most analysts are still positive on the stock. It's still well placed to benefit from the recovery in private capex, of which we've been seeing some indications. Now, of course, things have changed a bit of late. A lot. However, the stock has managed to remain steady. Today also, it's not fallen much in otherwise a market which has come off sharply off the day's high. The outlook on its international order book, both on infrastructure as well as the hydrocarbon segment, is pretty good, and valuations roughly at about 20 times forward earnings is not all that expensive according to brokerage house Prabhudas Leeladhar.
Santo, you talk about narratives, right? We talked about the steel space, how the narrative has shifted. I think for L&T also the narrative has shifted. When we were heading into this year, into this financial year, the entire talk was about how the private sector CapEx is going to come back, how the government is going to ramp up infrastructure spending, and therefore order inflows for L&T are going to be very, very solid. Even before Saturday, the guidance that the management gave about 12 to 15% growth in order book as well as sales in FY23 looked very achievable, right? But Saturday, the entire narrative has changed for the capex side, right? The government's measure on the steel sector has basically taken the wind of the sail of one of the sectors which had led the private sector capex revival. Apart from that, the fact that fiscal deficit is now going to stand at about 6.9% instead of 6.4%, that means government's own capex could see a cut of as huge as 1 lakh crore according to Barclays. So at this point of time, the the guidance of 12 to 15%, which just few weeks ago seemed very achievable, is now appearing to be a very tall task. And therefore, for me, I don't think L&T at this point of time is a great bet to be in, even from a very tactical point of view.
If the downturn persists clearly, I always feel that there will be a clear shift towards quality and earnings visibility. So, of course, the growth rate may not be as high, the order intake may not be as high, but it's still the backlog is quite strong. Its order book is still pretty robust at this point in time, and I think that will provide an earnings cushion, even if at a slightly lower multiple which the market may give. I think L&T still is a safer bet in these kind of markets.
I doubt, Santo, with inflation going the way it is going, and with the government, a lot of the analysts in consensus that the hike in export duties is hardly going to trickle down to sectors which consume steel, and L&T is one of those, given that it uses steel in a lot of its construction project and all. I think the higher construction cost is a very big execution risk for L&T, and at 20 times forward earnings for a growth of barely probably 9 to 10%, I think this is a more expensive bet than some of the more cheaper stocks available out there. That said, one stock which is actually looking very cheap is Hindalco. The stock has been in the forefront of the sell-off that we have seen in the metal stocks over the past 1 month. If you look at it from a demand story, from a structural story, there is actually nothing wrong with Hindalco. The export duties hike that has happened for pellets and for steel largely does not affect the aluminium space, right? Overall, aluminium demand both at home as well as abroad remains good. The outlook there remains good, because if you're expecting auto sales to recover later this year, then aluminium definitely recovers because of that. Internationally also, you have seen how aluminium markets have been tight. There have been plant closures, there have been mine closures, and therefore overall aluminium supply is quite tight, and export story therefore remains quite good. The company has embarked on a major capex over the next 5 to 10 years of about $8 to $10 billion. So that is going to again enhance its capacity. So for me, given the fact that the stock has corrected almost more than 20% over the past few weeks, it has made the risk reward again very attractive. If you look at Kotak Institutional Equities, they have added Hindalco to their model portfolio and raised the weight by as much as 200 basis points, Santo. So that goes to show even the optimism on the street for the stock, even though it has fallen over 20%.
Well, before I counter you on that one, a quick look at the market.
Yeah.
The fall has intensified. Now the Sensex is also in the negative at this point.
It seems like both are going to...
Yeah, and the Nifty is down by close to about 0.4%.
0.4%. And mid-caps actually are leading the losses right now, Santo. Mid-cap 100 index is down about 0.4%, whereas the small-cap index is down about 0.7%. So the broader market of second-line stocks are taking it on the chin at this point of time in the market.
Well, on Hindalco, CJ, again, the high prices in aluminum which we saw in March, that just didn't sustain. It went above $4,000 and it's come crashing down. One indicating that clearly there is demand destruction at higher levels. It just can't sustain. But more specifically, I think it's to do with Hindalco's surprise capex, which has caught the market on the wrong foot, and that's something market is still coming to terms with. So no doubt this is a long-term story. However, in the short term, the huge capex spend is going to weigh on sentiment, and the big demand that we are talking about, given the context of global recession, even a slowing economy at this point in time, I think these are factors which make me cautious of, in general, most metal stocks, I would say. Not all though.
Santo, I think market will come around to Hindalco. They will appreciate the fact that China is again going to come back to its feet, even if the West probably is going to slow down over the next 1 year. So there is, of course, the fact that March prices shot up a lot also has to do with the positions that were there out there in the market, and everybody knew those prices were not sustainable. But still, aluminum prices are still above where they were pre-pandemic, right? So that goes to show that the market dynamics is a lot more different from where it was in 2019, and therefore the earnings outlook or the earnings dynamic also need to be that way, and the market will ultimately appreciate it, I'm sure.
Well, the last stock on our watch list today, Steel Authority of India. Now, this is one stock, and I've been bearish on the metal space, but as I said, not all metal stocks. I would like to make an exception for this one. The stock has more than halved, from its peak, which was seen in last July, August, and at 2 times, trailing price to earning multiple, there is very little to lose in the stock is what I see. Probably in the near term, it could still slip a little bit because of negative sentiment, but among other steel stocks, probably this is best poised to rebound sharply.
Yeah, probably it remains, it could be a very good tactical trade, Santo. As I mentioned earlier, in the case of Jindal Steel as well, there is a hope that this is a very short-term measure in terms of the export duty hike that we have seen. Apart from that, the company has been over the past 1.5 years reducing its debt quite considerably. It has utilized all the cash that it has generated from higher prices and taken down its debt, which was always a major concern over the past 10 years for SAIL, and therefore the cheap valuations that we have seen. But that said, the longer term story, there still hangs a question mark over what will SAIL be in the next 5 years, right? Of course, it is doing capex, of course, it is expanding capacity, but will SAIL be a private entity or will it still remain a public entity? Because let's not forget, a large part of the rally that SAIL saw in 2020 to 2021 was driven by the hope that the government will probably finally capitalize on this asset and privatize it along with BPCL. We know what has happened to BPCL, but we still don't know what has happened to SAIL. So that is one thing that the market will definitely watch out for. That said, am I missing something?
Well, yes. There is still no clarity on when the National Stock Exchange will go public, but despite that,
we have been waiting for that for what, 5 years now?
A very long time. From the time, I think in 2016 it was when they had filed the first DRHP. Yeah. Now, despite there being a complete lack of clarity, you're seeing frenetic trading in shares of NSE over the
interesting.
Yes. Now, last year itself, in FY22 itself, you saw close to about 5 million shares changing hands on an average
in an unlisted market.
In an unlisted market every month, which means that roughly 250,000 shares of NSE were being traded every day, and that's more than what most mid-cap companies can boast of. Now, again, the interesting part here is that there is good demand from HNIs, no doubt, and that interest has only intensified over the last few months. But what slightly stands out is that there's a huge disparity between what the peak price for a month is and the minimum price. So it ranges all the way from 3,710 down to about 840 or 900 bucks.
That is very odd. Even for an unlisted market, that is very odd.
That is very odd, because normally you would see some 10 or 15% range, because deals in an unlisted market depend on a lot of factors. It depends on who's in a hurry to sell or buy. So that sets the prices. But in this case, you're seeing a big difference in a wide range there. Now, what brokers in the market are saying is that this could be one of the tools for tax evasion also. So you strike a deal at what looks like a very low price on paper, but the buyer and the seller then later kind of they settle the rest of the amount in cash. So you've dealt
seriously.
Yes. So otherwise.
And this is happening under the nose of the authorities?
Yes, and this has been happening for quite some time now. So that partly explains the huge volumes that you've been seeing in the unlisted NSE shares.
But why NSE only?
It could be happening in some of the other, but you see NSE, there is a very credible story, because earnings are pretty strong. Last year the earnings per share was about 104 years for FY22, 53% increase in top line. Operating margins are close to about 70%. It's almost a near monopoly. In the cash market, 93% market share. Derivatives market, it is almost the the only player in the game.
Almost 99% market share.
Yeah, and globally, in terms of derivative contracts, it's the biggest. So there is everything going in favor of NSE. So that there is that interest is kind of justified. And if you were to apply the same valuation parameters as you do for the BSE shares, which are quoting at about 35 to 40 times the trailing earnings. By that logic, NSE shares should be quoting at close to anywhere upwards of 4,000 rupees. So there is definitely interest in that. I'm not saying that all the deals are just being done to kind of save on taxes or evade taxes, but a fair bit, at least the outlier deals could be explained by that.
Santo, it seems like you have given the assignment to somebody in North Block or in South Block at this point of time. That said, on the horizon tomorrow, we will, of course, the earnings will be in the focus. But apart from that, the Federal Reserve Chair, Jerome Powell, will be speaking later tonight, and his words will be, the market will be hanging on every word that he has to say in terms of how the rate hike cycle is going to go forward from here on, whether we will have 75 basis points on the menu come the June meeting. Apart from that, in terms of earnings, you have Adani Ports, Grasim, and Zomato coming out with their Q4 earnings. And another thing that you may not want to miss out on is the coverage of the World Economic Forum at Davos. Moneycontrol is bringing you report from the ground zero, and you can follow us for all the updates regarding that. And here is a short snippet of catching the entire first day's highlight for you.
Welcome to the gorgeous Davos. So come, hop on this journey with me only on Moneycontrol.
Looks great, Santo, doesn't it? And for the first time, the World Economic Forum is actually happening in spring instead of the snowy white that we are so used to.
Exactly, yeah.
That said, we should let you get back to your trading with about 10 minutes left on the clock for the market to close. Hope you have a good end of the day trade, because this market has been very, very volatile and we do not know yet whether we'll close in the red or in the green.
So that was all that we have in this edition of Market with Santo and CJ. Thank you for watching. Hope you liked it, and do share your feedback in the comment section below.
And do please follow us on the social media links at the bottom of your screen. For rest of your financial market news, stay tuned to moneycontrol.com and the Moneycontrol app. We will see you tomorrow morning sharp at 9 a.m. Thank you.
Thank you.